Okay, so let's start. So I'm Philippe Rideli. I'm a managing director at Kaiko, and we're absolutely delighted to host today's webinar on making tokenized money market fund collateral operationally real. And we do this in collaboration with our partner Ownera. This session is part of a pre-Agora webinar series, and that leads up to the Agora conference in Cannes this May as part of the annual Ethereum conference. And for those joining us today, you can learn more about the Agora at agora.kaiko.com. Now, without further delay, let me hand over to Natasha for a few words before Armin, our moderator, starts the session. Natasha, you're on mute.
Sorry about that. Thank you, Philippe, for inviting Ownera to co-host this with you, and to our esteemed panel. We've got some of the industry leaders talking about tokenization today. So it's a real pleasure for Ownera to be partnering with Kaiko on this. Thank you.
Perfect. Natasha, Philippe, thank you very much. And yes, I would like to welcome you all here on this webinar as well. Philippe already mentioned the title, Making Tokenized Money Market Funds Collateral Operationally Real. I would say as well, from the sandbox to production is today's topic. Hopefully we're going to learn quite a bit. Certainly we're going to learn about the fact that tokenization alone doesn't solve the collateral problem. The operational infrastructure in the end does it. And to that we can count the regulatory layer, trusted and regulated data from automated decision making, and last but not least, certainly the workflow orchestration. Philippe and Natasha, they already introduced themselves, but with us we have as well Kim Hochfeld. She's the global head of cash, securities, lending, and digital assets at State Street. So welcome, Kim. Thank you. And Nate Pola, he's the technical product manager for Franklin Templeton digital asset team. And my name is Armin Peter. I'm the GDF board member and your moderator for this webinar today. Now, ever since last year's Genius Act, we have seen the starting gun being fired on the development around digital asset space and the transformation of financial markets, in my opinion. From TradFi to DeFi to CeFi, everyone seemed to work on their digital strategy and or transformation strategy in particular. And beside the topic of stablecoins, there is one other hot topic in town, globally discussed, and comes with a lot of expectations. The topic of tokenized money market funds and their use in collateral operations. Now, with more than 25 trillion of collateral globally in use and circulation, it becomes rather clear why that is and why there is such focus on this topic. And we do as well know that collateral starts moving particular at times of stress and volatility, which unfortunately, in the light of the events in the Middle East, has certainly been the case of late, I guess. Now, let's start with Kim. When looking at the past couple of weeks and previous historic events like the LDI crisis in 2022, what is it that is needed most, and what are the lessons learned on where the collateral infrastructure needs to go? And in some way, are the hopes that tokenized money market funds can really help, really justified?
Thank you, Armin, and I'll take the answer to that last question first, because I think I can say unequivocally and unambiguously, yes, absolutely, tokenized money funds can help solve and resolve some of the stresses in the collateral market that exist today for a variety of reasons. So I'm going to wind the clock back a little bit to an event you mentioned in your opening comments, which is the LDI crisis in 2022, because I think it illustrates very clearly how inefficient collateral movement is where we don't have the ability to move collateral atomically 24/7 in a programmatic way, which is clearly something that the blockchain and blockchain technology offers us today. So back in 2022, We saw a huge sell-off in the gilts market after the unfunded budget that was announced by Liz Truss in the UK. And what that meant is that many of the large LDI managers in the UK, so those that were holding long-dated derivatives on their liability book, had to post more collateral because the price of their gilts had gone down, and that meant there was a collateral shortfall on all the interest rate swaps on their books. So what that meant is they needed to find cash, and they needed to find cash quickly. And many of those large LDI managers also happened to run sterling-denominated money funds where they kept some of their LDI cash that could be used for collateral purposes. So off they went to their money fund desks and said, I need to redeem a large amounts of money very quickly. I need to post this collateral either to another counterparty or on an exchange. The money fund manager didn't have that much cash in their portfolio and needed to sell underlying securities. What were the vast majority of those underlying securities? They were UK gilts. So suddenly in a market where you saw huge downward pressure on gilt prices due to the budget that had been announced, you then exacerbated that downward pressure because large institutional holders of gilts were suddenly forced to sell into a spiraling market. So you can see here how we had a perfect storm in the wrong direction at one time, and the end result was the authorities had to step in to stabilize gilt prices, but not just the systemic crunch of everybody reaching for cash collateral and selling the same security at the same time. What was also happening is that it was taking quite some time for those portfolio managers to get the cash back, for that cash to move across in the system, for the collateral receiver to take that cash and then potentially reinvest it in a gilt. So just a very circular, slow way of moving collateral through the pipes. Now, tokenized money funds solve all of those issues in one fell swoop. If you could keep your cash collateral in a tokenized money fund unit, rather than having to redeem that money fund unit into cash at a transfer agent, for the transfer agent then to wire that cash through SWIFT or the banking system to the collateral receiver, you could just take that tokenized unit, move it on chain 24/7. And in fact, that movement could happen programmatically and automatically when the price of the underlying collateral moved, and the collateral receiver then is made whole, and there's no forced sale of the underlying investments in those money funds, causing a systemic run. So that goes back very neatly into the simple answer to your question. Yes, tokenized money funds can solve a lot of the stresses and operational challenges that face collateral managers and collateral pledgers and receivers in today's markets. We have a lot of other issues to work through, particularly regulatory on this front, but you can see the vision where the industry is trying to get to. And I am a strong believer that all of the players in the ecosystem have a vested interest in getting all these various disparate parts of the system working together and the regulators comfortable. And the regulators are very interested because they can see the use case in order to enable a tokenized collateral money movement enabled through a money fund.
Perfect, Kim. I think you set the stage very, very nicely and explained very good the why and come to a very straightforward conclusion. And as you just mentioned, right, the regulator, it's a self-interest of the regulator as well. And how often does it actually happen that regulator and markets do have the same, let's say, vision and mission, in that regards, and maybe the second point I would make here, ever since last year, we hear the word of efficiency. Here it shows as well that inefficiency in the end is a systemic risk in some kind. So thank you very much for setting the stage quite nicely. And Natasha, just moving to you, was that actually very reason that we just heard from Kim, the reason why you mobilized, together with other participants, and came to GDF, to mobilize the industry to discuss this topic? And in your research paper and in your project and in your sandbox, most importantly, what have been the lessons from that project?
So exactly that really. the reason that we brought together the industry, and there was a lot of conversation happening around 2 years ago, around this is the perfect use case for tokenization. So there was a lot of work being done in real world assets, private markets, but actually when we came to the utility of tokenization, the ability to move assets around very quickly, reduce settlement friction, reduce liquidity pressure, that was the killer use case. And a lot of us recognized that very early on. There was a few test cases actioned in the market, which were done in what we can say now as walled gardens. And the feedback from most of the market participants involved in them was, it was great, it tested the technology, but the technology wasn't necessarily the problem. We know the technology works. What doesn't work is where my asset gets locked in a silo, and therefore I can't do anything with it. So an asset that has been tokenized to then live in a disparate system is less effective to me than regular assets. If I can't mobilize my asset, if I can't fund against it, if I can't use it for liquidity purposes, it's kind of irrelevant for me and actually would be treated badly by a receiving party. So this actually prompted us to pull together a group of working group participants. And it started out with some very bold kind of hands from the industry. Peter Left from Lloyd's, Kim obviously from State Street. We had Haida Jaffrey from UBS, all putting their hand up and saying, we're going to do this. This is how the way that we mobilize the market isn't by us doing like a little project on our own with a couple of other market participants. Is really about establishing a consortium of banks with a vested interest. By doing this together, we're creating the market momentum to drive adoption. And that is going to be the way that this is then mobilized and institutionalized. And that really was the core thing. And as I say, it wasn't necessarily about the technology. The technology we know can do some super cool things, whether it's programmability, whether it's that smartness of what a contract can do. But actually, if you look at the way you interact in financial markets, there's lots of little spaghetti that exists to connect systems, even reconciliations of inventory within a bank is across multiple ledgers, different places. There's no aggregated view. So when you've got a treasury manager or a collateral optimization team running margin movements, there's lots of systems that are connecting into that. And so one of the key things was that we couldn't just rip and replace everything. Like, people have spent millions on integrating with some very cool technology that exists in the market for collateral workflows and optimization. And the key thing was to say, well, for this to scale, we have to connect to those systems and have the workflows just see digital assets as another settlement location and another asset that they can use in their inventory. So I think that's kind of the key message from me around, like, what did we learn from the sandbox? It is really that interoperability between systems, the way people work and the connections that need to exist. It's not going to be in a silo. It's not going to be in one blockchain. It is going to be across multiple different environments.
I think it's very key what you say, right? And we said it early on when Kim spoke about the systemic risk, right? Because of inefficiency, because of fragmentation in some way. Yeah. Here, it is very logic of what you are highlighting. In the end, it's about the connectivity, the interoperability. You realize you're acting in a system, so the system has to come together. It's not only two counterparts to come together. Philip, maybe I'm quickly moving to you and your role in this sandbox. Yeah, and Natasha already highlighted there was research on the one hand. We have heard Kim talking about the legal issues that we need to solve, and certainly that project with the GDF has done so. But really speaking about the operationalization, you need to go into a sandbox environment that Natasha just described. What was your role at Kaiko in this? Yeah, and what is is so relevant throughout the life cycle of that process when we speak about collateral management.
Yes, thank you, Armin. So Kaito, as a data provider, we were on the data side, obviously. So we all know where we're starting from, which is a siloed systems that are inherited from the last 50 years investments in banks. We all know what I think the whole industry either is working at to make it happen or is looking at others making happen, which is a fully data-driven, interoperable, omni-channel, automated system, financial system in the future. The sandbox is the bridge from the current situation to tomorrow's situation, right? So from a data point of view, the sandbox has revealed how we can fill the gap between what firms have now to handle money market funds and what they can have in the future, which is actionable data. So if I want to be precise, first you have a continuous valuation, right? And we can go down to sub-minute latency. It's not just about cross feed, but it's also about having data that you can operate in the systems across platforms, across blockchains, whether the funds are issued on, I don't know, Ethereum, Stellar, Canton, Polygon. The second thing is, thanks to this connectivity, we are going to shift to a more continuous market, right? So because the price valuation and the other information is provided on a real time, connectivity is now there, and we know that we're going to go through maybe 24/7 markets in the future. So a bit early. The third thing from a data point of view is the standardization. So we brought price and valuation data. The sandbox is about having volumes, having reference data, in the future having also fund components, and any other data that is needed in operations to manage tokenized money market funds in transactions and collateral. So from a data point of view is a continuous data flow with connectivity, meaning probably broader market times, and a standardization across assets and platforms.
Perfect. I think it becomes very, very clear to the something I'm hearing here in the background. So please go on mute if you can. It becomes very clear, Philip. On the one hand, we have the connectivity that Natasha was explaining, and the sandbox really created. On the other side is the realization that when we move to a 24/7 or instant or atomic, all the requirements of data actually needs to be there, right? In many ways. Natasha, before I go to Kim and Nate, actually on the producer side of these money market funds, what is it that after the sandbox we still need? We heard Kim earlier on talking about regulatory side of things. Is there still massive gaps if you're looking at, have we solved everything here in Europe already? And can you tell us just a little bit of what's actually now happening when it comes down to these two parts of research and legal consideration and certainty vis-a-vis the operational certainty?
So really, really good question. And actually, when we started the work, there was a sentiment that, look, the way that we do collateral movements is through creating custodial wraps or what the market would call a twin structure. And it's interesting because the twin structure lends itself to existing infrastructure and ways of moving collateral around. So tri-party agents, custodians at the moment move collateral around, and that is seamless. It works. People know what they're doing. And there was a kind of need from risk managers and compliance teams to almost fit tokenized assets into that framework. But what we realized very early on is that the token has different rights to it depending on how it's been issued and which legal regime it was issued under. So a lot of the analysis that was performed by Hogan Lovells and Bryony was around what is this token and what are my legal rights in an insolvency event if it's been kind of moved around. So yeah, tokens are issued all the time. People buy tokens, but what is the legal enforcement once I've pledged it or transferred it to someone as collateral? Do I have ownership over it, or is it still kind of legacy owned by somebody else? And this was like a critical point, and it actually then went into the regimes in which are used for certainly the European funds. So both Luxembourg, Ireland, and the UK were analysed. And all of them had different kind of rules. So Luxembourg was the most progressed in terms of having a specific digital securities kind of framework in place. We saw, and Nate will talk about this in a second, but we saw some great examples of some tokenized money market funds which were digitally native. And then we saw other challenges in certainly the UK and Ireland where property rights are still recorded in wet ink, and therefore it didn't mesh with tokenization. So you had kind of legal and regulatory issues that didn't quite work. And therefore, when we looked at assets issued in those jurisdictions, there was a bit more kind of sensitivity in that some things need to change in order for those assets to be acceptable. As I look to the US, is a little bit different, because in the US, we are able to now issue digitally native tokens. And helpfully, last week, we saw some amazing guidance coming out around the kind of what the token represents. And SEC also published some guidance papers around the different ways a token can be created. And I think this is super helpful, both from an operational perspective, but also from a risk management perspective. You're talking to risk teams now within collateral ops or within the bank and the credit teams, knowing that a fund token is the same as the fund is kind of helping open the door and get mobilization and certainly traction to use these things as collateral. But I would caveat that and say not all tokens are the same. So it's really, really important that the diligence is done, whether it's getting data from Philippe and the Kaiko team about like the pricing, the liquidity, the depth of the market, but also adding in things like rating agencies where possible, and identifiers like the DTIF, to really make sure that you know what your token is. And that for me is critically important. And all of that is passed around between the member firms.
Okay, perfect. Thanks for that. And as we've been halfway through the webinar, I would like to invite people in the audience to raise questions on the chat. So please come forward as you are following this conversation that so far has been dominated by Philip and Natasha and the scene setting of Kim. But we heard standards. We hear standards on the data side that Philip just mentioned, the availability of data more or less on demand for that process that is atomic, and we need standards on the legal side of things. And we recognize as well that what we have started here in Europe now travel to the US. I think Malta just earlier this week came out with a comment as well on tokenized money market funds and the use as collateral. So it really seems like all regulators around the world are on the case. But Kim, if I ask you, what would make a major institution like State Street really feel comfortable to move forward in production and on scale? Is it that on the technology side, on the process side, you have everything what you need, or are there actually gaps? Is it on the regulatory side? I mean, if you get certainty in the US, then you do everything in the US. But so you can start somewhere. You don't need to conquer the world immediately and all in one go. But what is it, that would make you feel comfortable actually to move on into scale?
I mean, there's not one simple answer here, Ahmed. It's multifaceted. I would say we're very comfortable with the tech at this point. The tech is now over a decade old. It gets better and better all the time, as things in the technology space do. But the tech has been well tested, and the number of market meltdowns we've had over the last 10 years as well has helped, pressure test the technology. We're comfortable with that. So we of course we worry about things like cybersecurity and quantum, but we feel that those risks are fairly well managed at the moment and well understood. The big hurdle for us is still regulatory. We are a GSIB bank. The asset management arm is 100% owned by a GSIB. We are highly regulated. We've been around for over 200 years looking after client assets. We've been managing client assets for 100 years. We need to make sure that everything we do is not operating in a gray area, that our regulators are comfortable with it, that our board is comfortable. So there are still some gaps. Those gaps are closing, they're being defined. Clearly, the regulatory environment is moving quickly. In some jurisdictions, moving very quickly, in other jurisdictions, moving more slowly. So we will focus our efforts where we have greater clarity. We will obviously focus our efforts where we see the opportunity set and where we see the client demand. So no, we're not going to conquer the world all in one fell swoop. We'd love to be able to, but the reality is that that doesn't fit into the model on how we think around this. We are moving where there is regulatory clarity, where we're comfortable with the risk profile, where we have signed off on the incremental risk or managed it down, where we're able to measure it, and where the client demand is. And I think that's the last piece of this puzzle. And I think all of us on this call, as well as in the industry, are very much in education process still in some of the large institutional players around the world. So everybody's grappling with this new technology, what it can bring, what the utility is. And it's not just us that needs to understand it. It's not just our regulators that need to understand it. It's also all the users on the other side. So it's a journey, and all of those pieces need to come together. And that's as much an art as a collective effort, but that's what's going to eventually help scale.
Perfect, Kim. And this is why we do webinars, right? For education purposes, and spreading the word. But we hear you loud and clear, and probably a key message to the regulators, right? We are feeling very comfortable with the technology in the process, at least on the State Street side. I come over to Franklin Templeton and Nate. Your experience in building and operating the Benji platform, including creating the one-chain US government money market fund. What capabilities are already in place, and would you agree to what Kim just stated? The regulatory uncertainty, is actually the key driver of it all, or what is it in your mind?
Yeah, that's a great question. And I find that it often helps to take a step back and think about why there is a push for tokenized products in the first place. I mean, as Kim mentioned, getting to the core of what is the client and investor demand, where does that come from, can be very helpful in assessing this. But ultimately, the push for tokenized products comes from a variety of different characteristics that don't necessarily exist otherwise. It might be fractional ownership, round-the-clock trading, and just quicker, cheaper settlement. But ultimately, it just bridges what we have to a digital Web3 space that allows for a larger possibility set of investor opportunities. And really also what I appreciate, which is lowering the barrier to entry for many investors. So at Franklin Templeton, we operate our own digital transfer agent because we believe that payments and collateral management can only be enhanced by blockchain. So for example, what we've done is over the course of our time working in this space has been to optimize the experience of a money market fund. This comes from allowing conversions to tokenized money market funds via stablecoins, as well as traditional banks, offering peer-to-peer transfers across the same chain as well as on separate chains, and then ultimately allowing for instant transfers and then user-managed self-custody wallets and something called intraday yield, which splits up the yield that's paid out to each user proportional to how long they've held it. So ultimately, all these different product functionalities, I talk about from a tech perspective, that's my background in this space here. And as Kim mentioned as well, the technology is all there. Everything that is needed from a piping and infrastructure Rails perspective is available. It's more of identifying the regulation behind it and when we can use whatever product functionality or underlying product within each region. And so We're excited to see how the regulation expands within the US and beyond, and what that means for widespread adoption of the technology and how it continues.
I think it's quite interesting, Nate, what you mentioned, right? And Kim mentioned it earlier on in terms of client demand. Yeah, all of a sudden we have actually new clients. Yeah, for a very traditional product. Yeah, in some way. And the question is, who do we conquer in the first place? Yeah, is it a traditional 8 to 10 trillion of money market funds investors? Yeah, or is it actually a whole set of new clients in that regards, right? Kim, what new features do you actually expect? Yeah, I hear you loud and clear on the regulatory requirement, and financial institutions only really are able to make the desired impact. Yeah, once there is this regulatory clarity there. No clarity, no movement. Yeah, no impact in some way. But assuming you would have, this clarity, or at places where you have that clarity, yeah, what kind of features are then, in addition, that we potentially don't have today, required to really move it to this commercialization of using it as a collateral?
I mean, I think we've talked a little bit about all of the features that are going to enhance that collateral mobility. So the 24/7 atomic settlement, the programmable smart contracts, the ability to receive or produce an intraday yield. So those are all product features that do not exist today, and can significantly enhance the whole collateral management experience. And I think those are the drivers that are going to really catch the attention of the institutional users in terms of, well, a lot of investors and people say this in the context of tokenized money funds or tokenized ETFs or tokenized equities. Well, it works well today. Why would I change it? But actually, it's the additional benefits that tokenization brings to the user, to the from a systemic perspective, that will really drive the adoption.
It's a lot of things happening in the behind the scenes, so to say, right? Which people don't
Absolutely.
necessarily appreciate. So I hear you loud and clear in terms of the pushback when it comes down to convince people of something new in a new process, right?
Yeah, and I think for our investors, they don't really care about the tech stuff happening in the background.
No.
That's our problem. It's our challenge is just to explain the added benefits that a tokenized product can now deliver to the end user. So we got to make it work. We've got to make sure it's robust. We've got to make sure it's regulatory compliant. And then it's taking that new shiny toy or newly enhanced toy, shall we say, to our investors and explain to them why this works so much better. So, and then, clearly the efficiency benefits, which are definitely not in the system yet, but I'm convinced over the next number of years, the costs of manufacturing on chain will come down as things start scaling. We will see those efficiency benefits as players in the ecosystem. So for an asset manager like ourselves, or for Franklin, those efficiency gains are definitely ahead in the road. They're nowhere near us at this point. And then some of those will clearly be passed back to the end user as well. So everybody has a vested interest in making this work alongside all of the other features around 24/7 atomic settlement, programmable trading.
Perfect. As we are moving into the last 10, 12 minutes of the webinar, and I mentioned it already earlier on, Q&A session. So please, we need more brave people like Abra actually posting questions. I have a question therefore for Philip actually, because Abra in the audience was asking, when you mention the different data layers and systems to integrate for real-time view, what different systems would on-chain need to be integrated with? Probably really is a question for you, Philip, no?
Unmuting. Natasha, I suggest I'm going to start answering on the data layer, and then I'll hand it over to you on the technology layer, right? I would answer in two parts. First is dynamic, right? At the moment, money market funds are not tokenized, so most information is still off-chain. The NAV, the shadow NAV, fund components are all distributed by fund issuers on the websites or through API. You can find some information on platforms. And the early adopters like Franklin today, who issued tokenized money market funds, well, obviously volumes, for instance, can be observed on chain. But this might change in the future, right? If we project ourselves in a future environment, there may be more things on chain. So I just wanted to say that what's off chain, on chain is not static. The second thing I want to say to answer the question on the integration is that we have to, I mean, we see the world in two parts, right? There's the data layer and there's the workflow layer. So I'm gonna let Natasha later answer on the workflow layer. From the data layer, it boils down to making sure that the right information reaches where data needs to be consumed. So that's the purpose of a data management system. So I'm not directly answering the question, but I'm giving some insights. What matters is to manage the ability to consume the data, so the ownership, IP, the destination, to manage so there's a whole world of functions that can be performed. When the data that needs to be there is brought into the systems, then the answer to your question is a workflow thing. And probably, Natasha, you can address that more deeply than I would be able to do.
Yeah, I think like for me, I know Kim said that the regulatory part is like the first thing that needs to be addressed. I actually think the connection, the plumbing is also something that we need to make sure that there is the right standard, the right interoperability in place, so that it's not a case of bilateral integrations for things. So yes, it's easy to connect to one chain and do a bilateral integration with them. It's still going to cost a lot of money, but it's possible, and it doesn't seem like a hurdle. But now we see the proliferation of chains in the market. So we have a joke in Ownera that says it's Blockchain Monday because there's a new blockchain that's issued. But if you actually look at the institutions and the use cases for blockchains, we're seeing some amazing bits of kit coming out. Layer Zero announced a couple of weeks ago their blockchain solution, which can handle a throughput of an enormous amount of transactions. So we're going to see an evolution of all these different blockchains, and maybe it's 150, maybe it's 1,000. We don't know. So the key thing is that your systems, and maybe it is an ERP system, maybe it's your treasury system, maybe it's your risk and compliance systems, they all need to interconnect in a seamless way. And it cannot be like bespoke, hard-coded integrations. Otherwise, you're going to blow up your tech. And it's not scalable. So the important thing, certainly from an integration standpoint, is that it is truly interoperable, that you're using technology that scales and that works with you. But then also to the data point, again, taking data from one source is not a problem, but when you have to proliferate it across the market and have the same data consumed by me, and there's no arbitrage between data sources, that's when having it on chain, having it published is really valuable. When you're consuming it from a collateral standpoint, it's very important that the risk teams, the credit teams understand what the collateral is and how it is priced, what's the depth of the market, what's the mark to market, what's the available bid offer on it, what's the current rating, has it been downgraded? These are really important decisions when determining if something is eligible to me as a collateral. And then even today, we were chatting with one of our partner firms, Cloud Margin, around, okay, in the future, when I'm optimizing, so in collateral management, you often look at what do I hold, what's my cheapest to deliver, and that comes mainly from what's my utility of other assets and what's the one that's going to be less worthy for me to use. And even as we look to the future in tokenization, cheapest to deliver becomes something very different. It's not just around, okay, cash is the best, treasury is the second, they're the ones I want to keep. And then the third is corporate bonds and things that are lower down in the credit spectrum. actually when we start looking at tokenization, we're going to be looking at what chain has it been issued on, what's my settlement latency, what's the gas fees associated with it, do I get transparent information, what network's it on? So all of these things play into how the tokenization is going to then feed in for eligible assets. But yeah, one chain over the other, not really kind of a problem as long as you've got the interoperability sorted.
So it does show as well, when I asked you earlier on about the gaps, right? It's not a simple, straightforward one answer. Multiple things still to be considered. But as you say, cheapest to deliver. The value is really changing. Yeah, the narratives once the technology is actually full functional. I actually want to make sure that we continue on the questions. Yeah, and we are getting a lot of questions now on the chat. Certainly not be able gonna answer all, and hopefully this one is one just yes or no. Greg was asking, in the US, is it already possible to legally, technically, and from a counterparty documentation standpoint, use a tokenized money market fund share as intraday variation margin in a bilateral derivatives trade? Natasha, you're going with your head up and down. That is a yes.
Yeah, certainly. There's been some really good papers published by ICMA and ISDA. Armin, I'm sure you and ISDA as well, in terms of tokenized money funds, and even last week the guidance that a tokenized version of a security is the same. The technology doesn't change the nature of that asset. And as we look to those specific contracts, that's where certainly the guidance that we've had from those agencies have been that it is possible to use tokenized versions as collateral. I think the main change that needs to happen is CSAs. At the moment, they're not calling them out specifically as eligible assets, so there might need to be some rework in the schedule, and that's what the dealers are doing at the moment with their counterparties. But now we see more and more funds being issued. The need to adapt those CSAs is greater.
Okay, Natasha, thank you. And maybe a question then, just in addition to that, to Nate and maybe particularly to Kim, from Jonathan on the legal side of things. Yeah, feeling this is a technical webinar, but at the same point in time, very much dependent on the legal side. With that said, are you able to provide any details about contractual change that may be required to support parties' utilization of tokenized money market funds for collateral? Is there something that Nate or Kim, you both could mention at this point in time that would help Jonathan?
I'm going to go back to Natasha's comments on the CSAs. So we're clearly not here to provide legal advice, but the CSAs definitely need to be updated.
Yeah.
And I would say I'm no legal expert, but something to keep in mind in this case is that when we have different assets that operate on a completely different clock, or maybe we have yield distributed in different ways, there is it opens the door for a whole new variety of investment strategies and different optimization techniques. And so that's something that I'm excited to see, is how those play into investment strategies from a portfolio management standpoint.
And how do you see, Emmanuel is asking that question, if you're establishing tokenized money market funds in parallel to traditional ones, will we see somewhat operationally or market liquidity wise some sort of impact on the existing market? So a bit of a fear of, if liquidity moves on to something new, what happens to the old. Kim, you already
No, definitely not. This is new money, and I think this is why the money fund industry has been quite quick to jump on this bandwagon. These are pools of cash that we have not otherwise been able to access. So this is incremental, and hopefully will provide more liquidity into the treasury market, essentially.
Perfect. Right. I think we have only 2 minutes left, and often at these seminars or webinars, it's always a bit of a forward-looking lens. How does success look like in 12 months' time? What does need to happen to really unlock and make the next big step? And probably Nate, I'm going to start with you.
Yeah, I would say for me, success would look like is for investors to have access to the right tools, as well as sufficient knowledge to make informed decisions. I mean, a lot of this does come down to understanding which will be used when? I mean, in the example of collateral, it's being conscious of the utility of the underlying vehicle in which collateral might be held, as well as the overall investment goals. And so, I mean, for me, I would say understanding how you can, in my case, maximize yield and mitigate risk, and what those look like from an off and on-chain perspective. I think if we're looking back, what would be ultimately effective is understanding how these new products, this new world of tokenization can be used as a way not to necessarily replace, but supplement the traditional financial system, and to see the synergies and how those two can interlock in a very effective way.
Seems like you speak of the bottom of the heart from Kim, but Kim, over to you, one sentence.
I can't beat what he said. I'm going with everything Nate has already enumerated.
Lovely. Okay, perfect. Then I move on to Philip.
Yeah, on my side, so the other side is the provider of systems, data, etc. So a successful situation in 12-month time from us is that we are able to distribute to the Ownera systems the right data from the major tokenized money market fund issuers, and that's in production in the Ownera systems. The right data at the right place. Natasha, over to you. Last sentence.
Well, Ownera is the system to be using here. So yeah, for me, it's live, operational. We're seeing flow. We're seeing that actual mobility. We're connected to legacy systems like Arcadia and Cloud Margin and Transcend. And everyone's saying, wow, this has changed my life. So that's 12 months from now. I think it's possible. And yeah, the call to action is get involved now.
Perfect. Says the connector, of the distributor of the right data at the right place at the right time. And as Nate and Kim were saying, access to the right tools with the sufficient knowledge. Hopefully, this webinar enhanced your knowledge. Certainly, we heard about the fact that it's a killer use case without any doubt. The worry is not about the technology; it's more about the legal side of things and the certainty that we get there. We heard about the fact we need standards, standards in digital communication. We need standards on the legal side of things to have certainty, to make an impact. And hopefully, we're going to see many of you on the 31st of March in Cannes at the Agora Institutional Forum of Kaiko, where digital finance meets open thinking, where we discuss the connect between the TradFi, the DeFi, and the journey to CeFi, most likely. And with that in mind, I say thank you very much to Natasha from Ownera, Kim from State Street, Philip from Kaiko, and Nate from Franklin Templeton. Thank you very much, and have a good afternoon.
And thank you, Armin, for moderating this webinar. Thank you.
My pleasure. All the best, everyone.